Welcome to the deep dive. We've got quite a stack of sources here today, articles, some research papers, market analyses, all focused on three, well, pretty significant tech companies, AMD, Intel, and Shopify.
That's right. And our goal here, our mission in this deep dive, is really to sift through all this material for you, our listener, and pull out the most crucial insights, maybe even some surprising bits.
Yeah, think of it like a shortcut, a way for you to get up to speed quickly on what these specific reports are saying about where these companies stand right now, their recent performance, their big strategies, and the key challenges they're facing.
Exactly. And the plan is pretty straightforward. We'll tackle each company one by one. We'll pull out the key numbers, dig into the strategies they're deploying, and look closely at the risks highlighted in the material. So, shall we start with AMD?
Let's do it. Okay. AMD. The sources paint them as, a leading semiconductor company. They're based in Santa Clara, California, and really focused on high-performance stuff, computing, graphics, visualization, basically the tech-powering data centers, gaming, embedded systems, that kind of thing.
And if we look at the stock context provided here, this is as of May 17th, 2025. AMD was trading around $117.17. That puts their market cap at roughly $190 billion.
Right. And a number of people often look at the PE ratio, price to earnings.
Yeah.
How much investors are paying per dollar of profit. The sources have AMD's at around 26.
Which suggests, current profitability. And important for some listeners, the sources specifically state there's no dividend yield for AMD currently. They're reinvesting, it seems.
Okay, shifting to Q1 2025 financials. The picture here, reading through this material, seems, pretty strong overall. Robust results, good growth in their main business areas.
The numbers definitely back that up. Revenue hit $7.44 billion. Now, that's a really significant jump, 36% higher than the same quarter last year.
But the number that really pops out, according to these reports, is the bottom line. Net income. It just soared to $709 million. Now, compare that. Wait, let me check this. Yeah, the source actually compares it to just $36 million operating income in Q1 2024, while net income was $125 million. Okay, so the $709 million net income is a 476% increase from Q1 2024's $125 million.
Huge.
And GAAP EPS, earnings per share using standard accounting, big jump there too, from 0.07 cents up to 0.44 cents.
Yeah, that kind of operational leverage is impressive. And their gross margin, the profit just from making and selling their stuff, also ticked up slightly on a GAAP basis, 47% to 50%. And operating income saw that massive leap you mentioned earlier, $806 million versus just $36 million the year before.
So if you boil down these financials, what's the main message these sources are sending about AMD's health right now?
It really points to strong financial health.
Yeah.
And crucially, an ability to actually capture the demand out there and turn it into, real revenue and profit growth. These aren't small bumps. That net income increase is especially striking.
Let's break down where that growth came from in Q1. Which parts of the business were firing?
Well, according to the sources, the data center segment was definitely a powerhouse. It brought in $3.67 billion in revenue, which is up 57% compared to last year. That's being pushed by demand for their EPYC server chips and those Instinct GPUs, key components for AI and high-performance computing.
And their client segment, which is more the consumer PC side of things, that actually grew even faster.
Yeah, that's right. Revenue there was $2.29 billion, up a massive 68% year over year. Really fueled by Ryzen processor sales. That is the fastest growth rate across their segments for the quarter, which suggests, maybe a strong PC market recovery or share gains for them.
But not everything was up. The gaming segment.
No, that was down. Revenue there was $0.64 billion, a 30% drop year over year. The sources say that's mainly due to lower sales of their semi-custom chips, the kind that often go into game consoles.
Okay. And the embedded segment?
That saw a small dip, down 3% year over year to $0.82 billion, though the reports suggest maybe a gradual recovery is expected there later in 2025.
So the main story, the emphasis in these reports, is clearly data center and client driving that really impressive overall revenue growth for AMD.
Absolutely. Those are the big engines right now.
Okay, beyond the raw numbers, AMD's been making some strategic moves highlighted here. They closed the ZT Systems acquisition in March 2025. $4.9 billion. What's the play there?
That seems like a direct move to offer more complete AI solutions for data centers. ZT Systems brings infrastructure capabilities, AI, and general compute stuff. So AMD can offer more of an end-to-end package, not just the chips, but more the system around them. That's pretty important in the AI race.
Makes sense. Moving up the stack a bit.
Mm-hmm.
And then there's this huge partnership noted $10 billion over 5 years with Humane in Saudi Arabia.
Yes, a very significant deal. It's focused on building massive AI computing infrastructure there, like 500 megawatts worth. It's a major strategic move, plants AMD's flag firmly in the Middle East AI scene and locks in a huge long-term commitment.
The sources also mentioned a big stock buyback program. They kicked off a $6 billion one, bringing the total authorization up to about $10 billion. What's that signal?
Generally, that's seen as management being confident about the future, right? And it's a way to return cash to shareholders. Basically, they think their own stock is a good buy.
So looking at these moves together, the acquisition, the Saudi deal, the buyback, they seem laser-focused on capitalizing on AI growth and expanding their global reach.
Absolutely. These are very proactive steps aligning directly with where these analyses see the big market opportunities.
Okay, now for the other side of the coin. The risks and challenges that could, potentially slow things down. One big one flagged is export restrictions.
Right. New rules affecting their MI308 shipments to China are specifically mentioned. The sources estimate this could reduce revenue by about $1.5 billion for the full year 2025. So it's a direct, quantified hit.
And of course, this industry is just hyper-competitive. You've got NVIDIA, especially breathing down their neck in AI GPUs, and Intel is always a factor, even if they're in a different spot right now. Innovation is table stakes.
Mm-hmm. And supply chain issues are always lurking in semiconductors. The sources mention constraints as a potential risk, maybe limiting their ability to meet demand even if it stays strong.
So putting it all together, the strong Q1, these strategic initiatives, and these risks, what's the core takeaway on AMD from these sources?
I think it's that they're executing quite well, especially in those hot areas like AI and client computing. But navigating external things like trade rules and keeping that competitive edge against some real giants, that's going to be absolutely critical for them to keep this momentum going. The analyst outlook seems generally positive, banking on the financials and AI strategy, but definitely with an eye on those external pressures.
Okay, good summary. Let's completely shift gears now and talk about Intel. Another semiconductor giant, obviously famous for processors, but the picture these sources paint is quite different from AMD's recent story. Intel's noted as going through some major restructuring under a new CEO, Lip-Bu Tan, who just started in March 2025.
Yes, the sources really emphasize that. He seems to have moved quickly on cost-cutting more workforce reductions after layoffs last year and a stricter return-to-office policy. Signals a real push for efficiency and maybe faster decision-making.
Looking at Intel stock context, again as of May 17, 2025, price around $21.66, market cap roughly $90 billion.
And here's a key detail the sources flag. Unlike AMD, Intel's PE ratio is NA. Not applicable. That's because they're reporting losses right now, which is a stark contrast. And similar to AMD, no dividend yield mentioned either.
Okay, so Q1 2025 financials. Sounds like they reflect a company in flux dealing with challenges, but maybe showing some early signs of these strategic shifts.
That seems fair. Revenue was $12.7 billion. Basically flat compared to last year, but the sources note it was slightly better than analysts were expecting.
But they reported a net loss of $821 million. And importantly, this loss was bigger than the $400 million loss in Q1 2024. So the financial strain is evident.
True. However, here's an interesting point the sources highlight. Their adjusted EPS, earnings per share on an adjusted basis, came in at $0.13. Now, that's significant because the estimate was actually for a loss of $0.22 per share. So while the standard GAAP net loss got worse, beating expectations on that adjusted number could suggest maybe some progress in managing costs or better than expected performance in certain areas hidden beneath that headline loss.
Okay. Their gross margin was down, though, 36.9% from 41.0%, another sign of pressure. But those cost savings you mentioned seem visible in operating expenses.
Yeah, OPEX was down 19% to $4.8 billion, so some impact there from the cost-cutting efforts.
So the key takeaway from Intel's Q1 numbers seems mixed. Losses are still the reality, but that adjusted EPS beat might hint that management is making some headway, or at least exceeding very low expectations, perhaps early signs from the restructuring.
It's definitely a mixed bag, yes. The overall picture is still challenging, but that adjusted figure provides a sliver of maybe positive indication amidst the difficulties.
Let's break down their business segments for Q1. The client computing group, CCG, the traditional PC chip business. How did that do?
Revenue there was down 8% year over year, hitting $7.6 billion. The sources point to ongoing weakness in PC demand and, well, intense competition as the main reasons.
Okay, what about data center and AI, DCAI? That's a key area.
That segment showed some growth, up 8% year over year to $4.1 billion, driven by AI-related server chips and storage. It's an area they're desperately trying to gain ground in.
Yeah, and the Intel Foundry business, where they make chips, potentially for others too.
Revenue there was $4.7 billion, up 7% year over year. So growth on the top line. However, the sources are pretty stark here. That segment posted a massive operating loss of $2.3 billion. So while revenue's growing, it's costing them a lot right now. It's a long-term bet.
Wow, that's a deep loss. And the all other segment, what's in there?
That includes things like Mobileye, Altera, smaller, newer ventures. That segment actually had the strongest revenue growth, surging 47% year over year to $943 million. And significantly, it turned an operating profit of $103 million compared to a loss the year before.
Okay, so while the core PC business is struggling, DCAI and that fast-growing all-other group show some potential bright spots for Intel based on these results.
Right, and the strategic moves under the new CEO, Lip-Bu seem aimed squarely at tackling these issues. We mentioned the job cuts and RTO aimed at efficiency and speed.
They've also cut capital spending quite a bit, right? CapEx?
Yes, significantly. Reduced the 2025 target by $2 billion. Now aiming for $8 to $11 billion, though that depends partly on getting funding from the PHEPS Act, the sources note.
And product-wise?
Big focus on AI. The sources specifically mention new products like the Panther Lake processors, which are slated for release late in 2025 as part of this push.
So putting these initiatives together, cutting costs, reducing investment in factories for now, focusing new products on AI, it really looks like an attempt to streamline, stabilize, and pivot towards growth areas like AI, and maybe eventually make that foundry business pay off despite the current losses.
It certainly looks like a strategy involving some short-term pain for potential long-term gain based on how these sources describe it.
What are the key risks and challenges flagged for Intel in this material?
Trade policy uncertainty is one. The sources actually anticipate a cost, maybe a few $100 million, in the second half of 2025 because of new tariffs expected in Q3.
And competition remains fierce. TSMC on the manufacturing side, NVIDIA in high-end computing and AI, those are huge hurdles.
Absolutely. And just the process of restructuring itself is a challenge. It can cause internal disruption, impact morale and short-term execution while they're trying to make these sweeping changes.
So, summing up Intel based on this material, they're grappling with significant losses and tough competition. But new leadership is making aggressive moves, costs control, efficiency, betting on AI, and foundry for the future.
Yeah, and the market outlook reflected in these sources is pretty cautious. Analysts see the potential in the restructuring and new products like Panther Lake, but the spotlight is really on execution. Can they pull off this massive pivot? That seems to be the core question.
Okay, let's pivot ourselves one last time to a completely different part of the tech landscape, Shopify. The sources describe Shopify as, a cloud-based platform for e-commerce, multi-channel, maybe best known for helping small and medium businesses, but the material really stresses they're increasingly targeting bigger enterprise clients. They list Mattel, Glossier, and recent ads like Reebok and Barnes & Noble, and they're based in Ottawa, Canada.
Right, and looking at the stock context, again, May 17th, 2025, price was $110.75, market cap around $140 billion.
Now, that valuation metric, the forward PE ratio, compare that to AMD and Intel. The sources highlight it's around 57. That's much higher, and as these reports suggest, it signals Shopify is viewed as a growth stock, where investors are paying a premium for expected future growth, not just current earnings.
Exactly. And consistent with that growth focus, the dividend yield is 0%.
Can you give us a quick rundown of Shopify's business model based on this material?
Sure. At its heart, the platform lets basically anyone create, customize, and run online stores pretty easily. Handles products, inventory, payments, shipping, the whole package. The sources say it powers over 2 million merchants globally.
And how do they make money? Where does the revenue come from?
Two main streams. Subscription solutions, that's the monthly fee merchants pay, and merchant solutions. Now, the second category is actually the dominant one now, making up about 79% of total revenue according to these sources. That includes things like transaction fees, payment processing through Shopify payments, hardware sales, shipping services, and even lending money via Shopify Capital.
Wow, 79% from merchant solutions. That really shows they're monetizing way beyond just the basic store subscription fee.
Precisely. It's about enabling the commerce that happens on their platform and taking a piece of that activity.
Okay, let's look at their Q1 2025 financials. The overall take seems to be strong revenue growth and solid profitability, even with some broader economic headwinds.
Yeah, revenue hit $2.36 billion. That's a healthy 27% increase year over year.
Their adjusted EPS came in at $1.25. The sources do note this was just slightly below analyst expectations by like a penny, a minor point, but it's in there.
But a really key metric for Shopify is gross merchandise volume, GMV. That's the total dollar value of everything sold across all the stores on their platform. In Q1, GMV reached $74.75 billion. That's up a solid 22.8% year over year. That GMV growth is a crucial indicator of the underlying health and activity of their merchant base.
They also reported good free cash flow, that is cash left over after investments, $363 million, which is a healthy 15% margin. And operating income jumped nicely to $203 million compared to $86 million the year before.
So the main takeaway here seems to be that Shopify's kept up significant momentum even after that initial pandemic boom. They're delivering top-line growth through that strong GMV and also improving operational efficiency, leading to good cash flow.
What are the main things driving this growth, according to these sources?
Okay, first is that push into enterprise we talked about. They have this commerce components solution aimed at larger retailers. Those recent wins, Reebok, Staples Canada, Overstock.com, Barnes & Noble, are highlighted as proof points. It's a clear strategy to move up market and compete more directly with the likes of Adobe Commerce or Salesforce.
Second driver mentioned is AI and automation.
Yeah, they're weaving AI tools throughout the platform, helping merchants with forecasting, pricing, customer support, even writing ad copy. This makes the platform more valuable, stickier. Examples mentioned are Shopify Magic for content and Sidekick for business help. They also note the acquisition of an AI startup, Audette, in 2024, which got rolled into Magic.
Third area, logistics and fulfillment.
Right. Now, they did sell off parts of their own fulfillment network back in 2023 strategically, but they still enable shipping for merchants, mainly through integrating with third-party providers, focusing on efficiency. An interesting point here is the challenge of competing with Amazon's logistics, and the sources mentioned Shopify recently reversed its ban on merchants using Amazon's Buy with Prime button, suggests a pragmatic shift.
And fourth, fintech monetization.
This is highlighted as a really high margin growth area. Shopify Payments processes a huge chunk of GMV, like 55%. Shopify Capital has lent over $5 billion to merchants over time. And they have Balance, offering digital banking. They're basically leveraging their central position in a merchant's operations to offer these valuable financial services.
So the big picture here seems to be Shopify layering these higher value services, enterprise tools, AI features, logistics help, fintech products onto their core platform to drive more growth and get more value and revenue per merchant.
That's exactly the strategy these sources depict. It's about deepening the relationship and the value proposition.
The sources also give a quick summary table of key metrics, Q1 versus last year. Revenue plus 27%. Adjusted EPS slightly down, negative 4%, noted as due to investments. Free cash flow margin steady at 15%. Gross margin around 49%, up a bit. GMV plus 22.8% and merchant count plus 12%.
Yeah, those numbers on cash flow, GMV growth, and the stable margins really reinforce that picture of operational strength that the reports emphasize.
Any other key partnerships or acquisitions mentioned besides Audette?
They mention ongoing integrations with Meta, Google, YouTube, that Buy with Prime reversal we discussed, and yeah, the Audette AI acquisition.
Okay, what about the risks and headwinds facing Shopify according to this material?
Macro sensitivity is a big one. Because their business is tied to commerce, it's naturally sensitive to consumer spending, inflation. If retail slows down overall, that directly hits GMV growth, their core engine.
Valuation risk is also flagged. With that high forward PE around 57x, the sources point out this is priced for pretty significant future growth. That makes it vulnerable if they stumble operationally or if market sentiment shifts away from growth stocks.
There's also mention of a potential change to the U.S. de minimis tariff rule. This could potentially raise costs for dropshippers bringing in goods from places like China, and that's a notable segment of Shopify's merchant base, so a regulatory risk there.
And like the others, competition. Amazon's marketplace is obviously huge, but also website builders like Wix, enterprise platforms like Adobe Commerce. They need to constantly innovate.
Right. So these are the key things that could potentially derail that high growth story that the market seems to be pricing in.
And leadership, what do the sources say?
Led by CEO Harley Finkelstein, who took over from co-founder Toby Lütke, is now executive chair. They get credit in these reports for making some strategic cost cuts after the pandemic boom and successfully refocusing the company on core e-commerce and empowering merchants. Seems like investor sentiment on the leadership is generally positive. Looking at analyst views in the sources, there's a consensus price target range cited, 12 months out, between $950 and $1,050. This is split adjusted, naturally. Analysts apparently see significant potential upside if the enterprise and AI strategies keep delivering.
And the longer-term outlook presented, say, towards 2025, 2030.
The view is Shopify evolves quite a bit, moving beyond just being a SaaS platform to more of a comprehensive provider of fintech, infrastructure, and enterprise commerce solutions. The catalysts are seen as scaling up those enterprise wins, really monetizing AI, payments, capital, and expanding omnichannel features. The ambition mentioned in the sources is quite grand, aiming to power 10% or more of global e-commerce by 2030, up from maybe 5% today. They point to the absolutely massive total market size, over $10 trillion.
And the conclusion drawn in this source material.
It basically frames Shopify as becoming a fundamental infrastructure layer for the whole e-commerce world. Things like strong GMV, the enterprise push, solid cash flow generation. These are highlighted as reasons it's seen as a well-positioned growth stock. The reports even lay out a kind of bull versus bear case summary. Bulls see them becoming the sales force of commerce, leveraging AI across millions of merchants. Bears worry about slowing growth, Amazon, and whether that high valuation can hold.
So ultimately, the material presents Shopify as a dynamic, high-growth company with a lot of potential, but also one where you need to keep an eye on execution and those macro and competitive risks.
Exactly. High potential, but not without hurdles.
Okay, let's try and tie this all together for you, the listener. We've looked at AMD showing really powerful growth fueled by AI and chip demand in data centers and PCs, and demonstrating some impressive profit improvements.
Then we examined Intel, a much bigger company, but currently facing major challenges. They're navigating the significant restructuring with a new CEO, trying to slash costs, boost efficiency, and pivot towards those same growth areas, AI, foundry services, but from a starting point of losses and intense competition.
And finally, Shopify. Not a chip maker, but building out that crucial infrastructure layer for online businesses. They're expanding aggressively into bigger enterprises, embedding AI everywhere, and building a serious fintech arm on top of their core platform, all while managing growth, profitability, that premium valuation, and sensitivity to the economy.
So why does doing this kind of deep dive into these specific sources actually matter for you? Well, it helps you see firsthand how very different companies, even within related tech sectors, are reacting to the same huge macro trends. Think about the AI explosion or the constant evolution of e-commerce.
Yeah, they're all dealing with external factors too. Trade policy, supply chains, fierce competition. But they're coming at it from completely different places, right? With unique strengths, weaknesses, and strategic game plans, all detailed in the material we've just gone through.
It gives you a much more nuanced picture, I think, of the diverse strategies playing out across the wider tech market, not just one single narrative.
So, to recap, we've unpacked the core story of AMD's strong growth areas and its challenges, Intel's really complex strategic pivot happening amidst financial difficulties, and Shopify's expansion into higher value services as it builds out the backbone of global e-commerce.
And importantly, we've drawn all these insights and details directly from that specific stack of sources provided for this deep dive.
Right. So maybe a final thought to leave you with as you digest all this. We've seen just how interconnected the demand for these high-performance chips from companies like AMD and Intel is, with the build-out of data centers and the rapid advancement of AI capabilities.
And then how those technological foundations, the chips, the AI are in turn powering this ever-expanding, ever-changing world of digital commerce, platforms like Shopify.
So what is this really intricate, interconnected dance between the fundamental tech infrastructure, the accelerating power of AI, and these shifting patterns in how we all buy and sell things, how businesses operate? What does that mean for the future trends you might start to notice? Not just in the stock market or the business news, but maybe in the technology and services weaving their way more and more into your everyday life.